Welcome to our webinar on IFRS 13, the standard dealing with fair value measurement. So what we'll cover on this webinar is an introduction to the standard. So why was it introduced, the background with respect to that. We'll talk a little bit about the scope of the standard. So what transactions, circumstances are within the scope of IFRS 13. Then we'll get into the definition of fair value and talk about the application of the concept of fair value as set out in the standard. We'll also discuss briefly the different valuation techniques that are referenced under IFRS 13, and then we'll finish off by discussing the disclosure requirements that the standard sets out. So let's start at the beginning. Why was the standard issued in the first place? Which is a fair question because the concept of fair value under IFRS has been with us for many years prior to the introduction of IFRS 13. And the way that it was structured before IFRS 13 was that in all of the various standards where fair value was either required or permitted, each of those standards attempted to explain what the concept was, so offer some kind of definition. And in some of the standards, and not all of them, it offered some sort of guidance on the application of this concept of fair value. And what the ISB realized after some time was that if one attempted to reconcile all of the different versions of a definition of fair value that were provided across IFRS, you couldn't easily reconcile them without picking up some tensions and some potential contradictions. And of course, that's not tenable. You need to have a concept, especially a concept that is as pervasive as fair value, must be very clearly defined. There must be a proper opportunity for it to be understood well so that it can be applied consistently in the marketplace. And at the end of the day, all of that just contributes to reliable and relevant financial reporting, which is what we're all after. And of course, in attempting to deal with that, it was also an opportunity to provide additional guidance. So being a relatively new standard and in line with the way that the ISB approaches new standards, it would also include a lot more detail around the application of the concepts that were in it. So it was also an opportunity really just to enhance the understanding of entities of the concept of fair value measurement in itself. So there are a number of standards which include elements of fair value. Now I wonder if I had to ask you to list them off the top of your head, how many you could list. So I'm just going to give you 5 to 10 seconds to think about that, so you can start jotting down as I'm speaking, just to think about which standards immediately spring to mind as you think about which standards require or permit the use of fair value. Okay, so let's hope you've got a decent list to compare with my next slide. So some of you might have come up with a list that includes some of these standards. So definitely if you had to simply search the term fair value across IFRS, it'll probably hit most of the standards that I've got listed here. And as you'll see in the next few slides, some of them are definitely within the scope of IFRS 13, whereas others have concepts which are similar to IFRS to fair value, but not quite fair value itself. And so IFRS 13 makes sure to be clear which of these standards would have concepts and circumstances that would be cross-referenced to IFRS 13 and which ones would not have that. So in order to understand the scoping paragraph of IFRS 13, you need to understand the positioning of the standard. So as we've said, we've long had the concept of fair value in IFRS. It predates IFRS 13 itself. And so it's not surprising that IFRS 13 is not the standard which will tell you under which circumstances you can apply the concept of fair value. that is dealt with in the individual standards themselves. So for instance, if an entity was accounting for property, plant and equipment, in doing so, it would turn to IAS 16. And in terms of IAS 16, it would find that it has an accounting policy choice that it can make between accounting for PPE at cost less depreciation and impairment, or using a revaluation model. And as we'll unpack a little bit later in this webinar, the revaluation model is based on determining a fair value for property, plant and equipment. So the policy choice that either requires or permits you to use fair value in that scenario resides in IAS 16 and not in IFRS 13. What IAS 16 doesn't do is explain to you how to determine fair value and what type of information to disclose in scenarios where you have applied fair value. It cross-references you then to IFRS 13 for that detail. And that exact same approach is then replicated across multiple standards where there is either a requirement or an option to apply fair value. So if you want to think about it in a kind of a simple way to think about it is IFRS 13 is a how to apply fair value standard rather than a when to apply fair value. So the when is determined by the individual standards which are dealing with the primary transaction, be it IAS 16 or IFRS 3 business combinations, IFRS 15 dealing with revenue recognition, etc., etc., etc. So in addition to that, what IFRS 13 also does is it separates from its scope those transactions that are within its scope for both measurement as well as disclosure requirements, and those that are within its scope only for measurement requirements and not disclosure requirements. And you'll see in the next slide or two, I will give you those examples of those scenarios. So the key takeaway for you on this slide is the when to fair value is in the underlying standard, the how to fair value and what to disclose is within IFRS 13. So if we just turn to the scoping paragraph, understanding that there isn't really an inclusion that is required in terms of what to include in the scope because the underlying permission is in the various standards. What is there in the scoping paragraph in IFRS 13 are certain things that are excluded. And these things are specifically excluded because the concepts that they relate to either use the term fair value explicitly, as in the case of IFRS 2 share-based payments, or they use a similar concept that could be confused for fair value, such as net realizable value for inventory or value in use under IAS 36, the impairment standard. And so in order to make sure that the IFRS 13 is not misapplied, its scoping paragraph makes clear, for instance, that IFRS 2 transactions are outside of its scope. IAS 17 or IFRS 16 now leases outside of its scope. IAS 2 net realizable value outside of the scope of IFRS 13. Value in use IAS 36 outside of the scope of IFRS 13. So these concepts in some ways are kind of similar to some of the techniques that we use to determine fair value, and so there was just a risk that IFRS 13 would be misapplied, and therefore that scoping paragraph makes it clear that those types of transactions should not have IFRS 13 applied to them. As I mentioned, the scoping paragraph also includes certain things that are measured within IFRS 13 requirements but are not disclosed in terms of the IFRS 13 disclosure requirements. So for instance, where you have applied IAS 19, those are employee benefits, and you might be dealing, for instance, with a post-retirement benefit obligation. And if you have a funded obligation, in other words, you have an obligation where you've actually invested some funds and therefore are holding what we would refer to in that standard as plan assets, those plan assets are required to be measured at fair value. So the measurement of the plan assets will be at fair value, and that will be within the scope of IFRS 13. But the disclosure requirements around those plan assets are not the IFRS 13 disclosures. For that, you simply go back to IAS 19 and you apply whatever IAS 19 requires you to disclose with respect to plan assets. So the measurement, guidance and requirements of IFRS 13 are applicable to plan assets, but not the disclosure requirements. And similarly, under IAS 36, where in terms of determining your impairments, you've applied fair value less cost to sell to determine your recoverable amount. The determination of the fair value part of that, of fair value less cost to sell, will definitely be within the scope of IFRS 13, but the information that you need to disclose around that will reside in IAS 36, and you'll not use the IFRS 13 fair value disclosures. So that's quite important to note, that there is measurement scope and there's also disclosure scope, and some things might be in one and not in the other. So, coming to the concept of fair value itself. So, as we turn to the different elements of that definition, we're just going to unpack on this slide what are the key things that you need to think about for each of those elements. So, in that definition, this transaction, and we're just going to keep in mind the perspective of a party selling or holding an asset and attempting to fair value that asset for financial reporting purposes. And in the hypothetical transaction, they're the party who are trying to sell that asset. So the first requirement that we're given is that all of this is happening in an orderly transaction. So what is an orderly transaction? So an orderly transaction is a transaction where it is not a forced transaction. The asset has been properly marketed, and so it's not all happening in a rush. And that's quite important, because if you had to do a so-called fire sale, the price that you would achieve in a fire sale compared to a orderly transaction where you can market the asset, you can expose it to a large group of potential buyers, and you can have proper price discovery, you would get very different prices in that scenario compared to a fire sale. So it's properly understood in terms of the definition that the price that we are attempting to simulate is a price that would arise in an orderly transaction, and not a transaction that would be disorderly. So as you think about this, I just want you to contrast this with what might be happening in the actual marketplace. So it could be that there's a crisis in the marketplace, 2008, 2009 global credit crisis, 2020 COVID crisis, markets in turmoil, etc. And you're going to have to appreciate the difference between what IFRS is saying and saying the price you're looking for assumes an orderly transaction, whereas if you open the window and you look outside, the markets may in fact be in disarray and be quite disorderly. And therefore it's quite important that you don't confuse market value with fair value. Fair value has all of these elements built into it that effectively try to have a framework around which this price is going to be determined. So the first portion is it's an orderly transaction. The second part is that it is happening obviously in a market. So transactions happen in a market, and a market is simply where buyers and sellers meet, whether that's physical or virtual, doesn't really matter, the concept is the same. And what's important to just unpack about the market is there isn't just a single market sometimes for an asset. So an example would be if you're a bank and you are participating in the foreign currency markets, it is quite likely that you are participating in the wholesale market. If you are an SME entity or even a large individual business that's just involved in commerce and you were transacting in a foreign currency, it's very likely that you would be transacting in the retail market for foreign currency. The same would apply for certain commodities where there's a wholesale and a retail market, etc. So it's very important that you then determine in which marketplace this hypothetical transaction is taking place, because the prices in the different markets will be different. So the retail currency exchange rate between the euro and the dollar will be different to the wholesale exchange rate between the euro and the dollar. And it becomes very important to understand that for your entity, the entity that's attempting to determine fair value, in which market does it participate in? And if it can participate in different markets, because the markets are, for example, have a barrier of a license or size or some other criteria, if it in fact could participate in a number of different markets, one of the things you would need to determine is in which market would the entity transact. And the logic that the standard sets out there is that it would seek to transact in the most favorable market, i.e. the market that will give it the highest net proceeds. So determining the market is also important in simulating and getting to this price that represents fair value. The next issue that we need to deal with then is the market participants. So with whom are we trading? And here you will have the familiar characteristics that you would have seen even before IFRS 13. So the assumption is that you're not a forced seller, neither are you dealing with a forced buyer. So it's a willing buyer, willing seller. The assumption is that the buyer is knowledgeable about the asset and everything that they need to know about the asset, so you don't have any pricing advantage because of information. So if you were, for instance, trying to determine the fair value of real estate, and as the seller, you know that there is some damp which has been covered up with a fresh coat of paint, and therefore potentially you have an information advantage that you know that there is some damp damage on the walls, and your potential buyer would not be able to see that. For the purposes of financial reporting, the assumption is that the buyer knows everything that the seller knows. So you cannot build into your valuation assumptions in order to get to the price. You cannot build any pricing advantage. So the assumption is there is market transparency around the asset. The assumption again is also that all of these transactions are happening at an arm's length. So these are not related parties that are transacting with one another, because we know that when related parties transact with one another, the potential for price that is pricing in elements that are outside the specific item that we're trying to value is quite high, and therefore we want to take that off the table. So in the definition, the assumption is that these are arm's length transactions between unrelated parties in the marketplace. So those are the parameters that definition that we read throw up, and those are the details that IFRS 13 gives you around understanding what is meant by an orderly transaction, in which marketplace is this hypothetical transaction going to occur, what can you assume about the characteristics of the other party to the transaction, and all of this happening at measurement date. So measurement date could either be at initial recognition, when you recognize the asset for the first time, or it could be at reporting date. So you have the asset now, and it's the type of asset that is measured at fair value, and therefore you are measuring that at fair value at the reporting date. It could be interim, it could be the full year reporting date. So the question that you might have is to say, well, why do we have all of these hypotheticals? Hypothetical counterparty with certain characteristics, which market we are transacting in, etc. All of these rules and parameters around what the circumstances around the transaction. And the reason for that is to try and introduce a level of objectivity in a fair value estimate. So fair value is always going to be an estimate. Unless you are dealing with a quoted price in an active market, and even that is probably still an estimate, because that was the right fair value at that moment, but you can only sell the asset the moment after that. So fair value is always an estimate. And in trying to at least narrow down the inevitable subjectivity that goes into evaluation is to try and build these broad walls around what you can assume as the context of the transaction. So, for instance, prior to this guidance, you had entities that would, in considering what the fair value of an asset would be, they would say, for instance, well, we are an unwilling seller because we don't want to exit this asset. Therefore, we would demand a premium in order for us to be persuaded to sell it. And they'd incorporate that premium into what they described as fair value. Now, clearly under this definition, you couldn't do that because one of the assumptions is that you're a willing seller. So you wouldn't demand an exit premium, which is only applicable to an unwilling seller. So effectively, what all of these different constraints that are introduced by this definition and the application guidance that comes with it are to try and introduce a level of objectivity, whilst all the time accepting that in determining fair value, you're always going to have subjectivity at some part of determining what that fair value ultimately will be. So that's why we have this hypothetical sale scenario defined in the way that it is defined in IFRS 13. So if I take you back, so notwithstanding that we discussed earlier that fair value is an exit price, there are instances, in fact quite a few of them, where under IFRS you need to initially recognize, when you initially recognize something, you need to measure it at fair value. So this would be the case, for example, with financial instruments. So IFRS 9 requires that when you recognize a financial instrument, it is initially recognized at its fair value. The transaction price, the actual transaction price, may differ from fair value. And there is an obligation on the reporter to be able to identify those circumstances under which the transaction price may not be representative of fair value and therefore do something with the difference between fair value and the transaction price. So some of the things that we would say you need to pay attention to around the circumstances of a transaction, which may indicate that the transaction price is not representative of fair value, would include whether there's an indication or not that the transaction was at arm's length. For example, if one of the parties was forced into the transaction for some reason, or you transacted with a related party, or you transacted in a non-traditional market setting for the particular item. So, there's an endless list of things to bear in mind, but I think what is important is to remember that the requirement, the onus is on you to demonstrate that you are recognizing items at fair value. You're not entitled to assume that the transaction price is fair value without applying some sort of a mental inquiry as to whether or not there's something there that you need to unpack. So if the transaction price is not fair value and the particular standard that you're dealing with, for example, IFRS 9 requires you to initially measure that item at fair value, you are going to then have a difference between the transaction price, which is affecting the cash flows, and the accounting entries which are at fair value, which you would have had to compute outside of what you've paid for the transaction. And typically the standard will tell you exactly where to recognize that difference. So in the instance of IFRS 9, under particular circumstances, that difference is recognized immediately in profit or loss. In other circumstances, it is deferred on the balance sheet and then recognized over the period over which that particular item is on the balance sheet of the reporting entity. So again, here all I would say to you is remember that your transaction price will be an entry price because you're actually the buyer. But if it's an asset, fair value is always determined from the perspective of the seller because it's an exit price. So just bear in mind those small nuances when it comes to determining fair value at initial recognition. In terms of subsequent measurement. So there will be those items that are measured on a fair value basis. And typically, to determine the fair value, one has to apply some kind of valuation technique. So IFRS 13 is not a standard that's going to teach you how to perform a valuation. So there isn't lots and lots of detail on how to determine discount rates and what to look out for in terms of forecast cash flows, how to pick comparable items, etc., etc. It assumes that you have a working knowledge of that. It assumes that an expert, if an expert is required, has done the valuation, and what it includes are the parameters around which that work should be applied for financial reporting purposes. So that's the context in which valuation techniques are discussed in IFRS 13. It's not really to try and teach you how to become a valuation expert in any fashion. Notwithstanding, the standard recognizes that there are, you could probably categorize valuation techniques under three broad approaches: your market approach, your income approach, and cost approach. And we'll talk about each of these in a subsequent slide. No matter which technique you use, ultimately the objective is to determine the price at which a transaction could occur, emanating from that definition of what fair value is, the price at which one would be able to sell an asset or transfer a liability. That's ultimately the objective of any technique that you're going to apply. There is a clear bias in the standard that we want to use techniques that rely on observable inputs as much as possible, wherever those are available. So if you have observable inputs, you need to use them. If you don't have them, then you need to go a step below that and use unobserved or unobservable inputs. Again, without attempting to go too much into the application of valuations themselves, one of the things that you need to be familiar with is often the valuation approach or technique that is applied is a function of a number of things, and one of those things is the availability of information to apply a particular valuation technique or approach. So you may find that in a given year you had a lot of information because of significant market activity that allowed you to use a market approach, and in another period you may have a lot less of that information around the measurement date, but you may have much more information, relatively speaking, about the income that that asset could produce. And so you might switch from a valuation technique that is a market approach to one that's an income approach, or between different sorts of market approaches, etc. And that's perfectly acceptable. So changing your valuation technique is treated as a change in an accounting estimate. So that means it's done prospectively in terms of IAS 8. However, you should just note that the standard IFRS 13 specifically requires that you would disclose the reasons why there's been a change in the valuation technique in order to try and tease out if there is potentially any selective application of valuation technique in order to give you a desired accounting outcome ultimately, which obviously is not what people are trying to do, but it's a legitimate concern, and therefore the standard asks you to elaborate on the reasons why there's been a change in the valuation technique. So speaking about those valuation approaches, so again, just to briefly speak about it, a market approach is effectively a technique that uses prices that are actually prices of market transactions. So you're not basing your valuation off other people's valuations. You're basing the valuation of transactions that have actually taken place in the marketplace relating to identical or comparable assets or liabilities, a group of assets and liabilities. So you're really saying these are transactions that we've seen on assets that look a lot like the asset that I'm trying to value or that are identical. And if I then make a few adjustments if I need to for any differences between the two, that's a great price for me to start with, the actual transaction price for something similar, for me to be able to work out what I could be able to sell my asset for. So that's really what a market approach is looking for comparables and then inferring a fair value based on the price of those comparable items. The income approach is an approach that places a lot more emphasis on future cash flows. So it's an approach that really is most suitable for items that have got a stream of cash flows associated with them. So that's why you'd find, the valuation of certain unlisted bonds, for example, might look to the income that is due under that bond, etc. Even some property valuations where they don't have good comparables, they might look at the rentals that property could earn and use that as a basis of an income approach. And effectively, it takes those future cash flows and applies an appropriate risk-adjusted discount rate to those cash flows and comes back to a present value, which we'll call fair value in the context of applying IFRS 13. And then the last approach to determining fair value is the oddly named cost approach. So the cost approach here is effectively an approach probably most suited to assets, non-financial assets that are quite unique, so there isn't good comparables and that don't generate an asset necessarily by themselves, but together with other assets. So there isn't a direct cash flow that you can attribute just to that asset itself potentially. And in this scenario where you're using this cost approach, what you're really saying is, and let's say it's an item or plant that produces your widget, you would say, well, my machine produces 10,000 widgets a week. That's its service capacity. And if I wanted to replace it, I might have to replace it with another machine that's in the marketplace that can also make those widgets. And its value is X. And mine's 10 years old, whereas the price that I'm starting off with for the price of the alternative item X is for a brand new item, and I adjust for wear and tear and age, etc. And I effectively work out what would it cost to replace the service capacity of the asset that I'm holding, and that would effectively be the fair value of that item using the cost approach. So as I said earlier, IFRS 13 really doesn't spend a lot of time invested in making you a valuation expert, but it wants to make you familiar with what the concepts must be, what the acceptable assumptions might be, and if needs be, if you needed to switch between one approach and another, how you would deal with those changes from one period to the next. Coming to the last part of our session, dealing with disclosures. So the disclosures are driven by the level of the fair value that we have determined after applying our valuation techniques. And the standard has set out 3 levels of fair value, and we'll go through each of those levels to explain what that means. So a fair value that has been determined using quoted prices in an active market for identical assets or liabilities is a level 1 fair value. So this is a fair value where there is the highest possible degree of objectivity. There is no management adjustment to the numbers that are observable, and you've simply taken the price from the market, and that's what you've applied to determine your fair value, and that is your fair value. Then that would be a level 1 fair value. So level 1 items that are measured using level 1 inputs carry the least amount of disclosure requirements because they are ostensibly more objective, so there's less to explain around how the fair value was determined. Next, you have your level 2 fair values, where the fair value itself is not an observed price in an active market for that identical item, but it does use observable inputs. So, for example, it might not be the exact item that you're looking to, but you're looking at something that is comparable to it. So you're looking at active prices for a comparable item, and then you're making some slight adjustments for the differences between your item and the item from where the observed price is. And so you are making some adjustments to observed prices, but your primary input that's driving the valuation are those observable prices, and that would be a level 2 fair value. And relative to level 1, this would carry slightly more in terms of disclosures that are required by IFRS 13. The last level is level 3. So this is where the inputs are not based on observed market information or prices, and effectively are inputs that are reflective of management's best guess of what that input ought to be. And management may be very experienced in the characteristics of that particular item, but because it is a management-driven input, it isn't possible for the user of the financials to independently get a feel for the reasonableness thereof. And so level 3 inputs would then attract the greatest amount of disclosure requirements under IFRS 13, because they would be subjected to the highest degree of subjectivity and uncertainty. So as we've said, the disclosures are driven by the level of your inputs. It could be that in a particular valuation, you've got observed inputs and you've got unobserved inputs, all used in different ways in a given valuation. And what the standard says is that whether it's a level 2 or level 3 will be determined by the lowest level input. So if you do have a significant input, for example, which is a level 3 input, but you have quite a few level 2 inputs that are also significant, well, then it's a level 3 fair value, because the level is determined by the lowest level of a significant input into that valuation. So we won't be going into any of the disclosures in detail on this webinar, but just to give you a feel, for example, of some of the disclosures that are there, and I've just used this one as an illustration, is a disclosure that deals with the level at which the fair value was determined for a given item, and it deals with whether or not there have been transfers in between reporting days between level 1 fair value and level 2. So this would be, for instance, where you were invested in Google and it is a listed company, actively traded, and in the prior year you simply took the price in the market, and that's what you used to value your investment in Google shares. And during the year, the management and board of Google decided to go private, so they delisted it, and now you don't have a direct price for Google, and you've had to try and infer what the price is. For example, you might have used the market approach and put together a group of comparable companies that you thought could give you the metrics that would allow you to value Google. So now you've moved out of a level 1 fair value to potentially a level 2 or a level 3, and this disclosure would require you to demonstrate. And so if I was reading to illustrate what that movement has been, so if I was reading those financials as a user, I would then have a higher degree of skepticism around whether the fair value of Google in the current year has been determined appropriately, because it's no longer based on a highly objective input such as a market, quote a price in an active market. So this type of disclosure tries to tease out those qualitative elements and quantitative elements that would give users insights as to the risks that are introduced in financial statements when you have the application of fair value in those financial statements. The other point that I would like to make with respect to disclosures is that, similar to the point that I made right at the beginning of the presentation when I was dealing with the scoping paragraph, where certain items, transactions, scenarios are scoped into IFRS 13 from a measurement point of view, because they are referred to IFRS 13 or they refer to fair value, but then are scoped out for disclosure purposes. Well, the corollary is applicable in the sense that everything that is measured at fair value, the IFRS 13 disclosures are applicable to it, in addition to the disclosures of the primary standard. So if you're measuring an item of PPE using revaluation under IAS 16 and you've applied IFRS 13, which you will have had to, then you will provide not only the IAS 16 disclosures relating to applying revaluation, you'll also include the IFRS 13 disclosures relating to how you've applied fair value in the financial statements in arriving at that revaluation. So you'll apply both standards in that scenario. The only time you will not do that is if IFRS 13 specifically excludes and gives you relief from the application of IFRS 13 from the disclosure requirements. An example of that I gave earlier was relating to plan assets under IAS 19 employee benefits, where the disclosures will solely be the disclosures of IAS 19 and will not include the disclosures of IFRS 13, notwithstanding that the plan assets would have had their fair values determined in terms of the application guidance in IFRS 13. So folks, that's IFRS 13 in a nutshell. I hope the webinar has clarified any misconceptions you might have had, just provided you with some good practical scenarios to think about, how the application of the standard might actually work in practice. So if you have any questions, please feel free to post your questions, and I will try to get to all of your questions and answer them. Thank you.